Hi, welcome back to the Mountain West IRA educational channel. I'm Diana Hoff. I'm going to be talking today about something that affects virtually every retirement account holder at some point in their working life. What to do with your retirement strategy when your income changes. And I want to be very upfront about something before we get started. Mountain West IRA is an administrator for self-directed IRAs. We're not financial advisors. We don't hold securities licenses. Everything you hear today is education, general information to help you have smarter conversations with your own qualified advisors. Got it? Great, let's go. Okay, here's the problem. Most people set up a retirement account at some point. Maybe when they get their first real big job or when a financial advisor told them they should, and they set it up. They pick a contribution amount and they more or less forget about it. Hey, I've done it too. And look, that's understandable. Life is busy. IRAs, 401ks, they are an exciting dinner conversation. Well, unless you live with me. But here's what happens when you do that. Your income changes and your retirement strategy doesn't change with it. And when that gap grows big enough, you start either leaving options on the table or worse, accidentally stepping outside the rules. Your income determines how much you can contribute, which accounts you're eligible for, whether your contributions are deductible or not, and what account types make sense for your situation. So, when income changes, your retirement strategy should be revisited. Full stop. Let's start with the basics, the 2026 contribution limits. We'll use the two basic IRAs most are familiar with for this explanation, a traditional IRA or a Roth IRA. The limit is $7,500 per year, $7,500 if you're under 50. If you're 50 or older, it goes up to $8,600. These limits apply to each individual. So, if you and your spouse both have IRAs, both of you have your own limit. The contribution deadline for 2026 is April 15th, 2027. That's tax day next year. And this is actually a very important detail because a lot of people think they have to make their contribution in January. You don't. You have until April of the following year. That's built-in flexibility, especially if your income is variable. Now, a critical rule, your IRA contribution cannot exceed your earned income for the year. So if you only earned $4,000 this year, your contribution can't be more than $4,000. Even though the limit is $7,500, earned income means wages, salaries, tips, self-employment income. It does not include passive income, rental income, Social Security, or pension distributions. So let's talk about rising income first, because it opens up the most options. If your income increases, especially through self-employment, a business, a side venture, a couple of things happen. First, you may now qualify for account types with much higher contribution ceilings. The two biggest ones are SEP IRAs and solo 401ks. So first, a SEP IRA. That's a simplified employee pension IRA. It allows employer contributions up to 25% of your compensation with a 2026 maximum of $72,000. If you're a business owner or self-employed, this can be structured as a self-directed account. Solo 401k. That allows employee deferrals up to $24,500 for those under 50 in 2026. And if you're over 50, that goes up to $32,500. And for those ages 60 through 63, I don't know why they picked those exact numbers, but 60 through 63, the limit is $35,750. Plus employer contributions on top of that. It's a powerful account for self-employed individuals with strong income years. Okay, let's see. The second thing that happens when income rises. Roth IRA eligibility may change. Roth IRAs phase out at higher income levels. For 2026, if you're a single filer, your ability to contribute to a Roth IRA begins phasing out at $153,000 in modified adjusted gross income and is completely eliminated at $168,000. For married filing jointly, the phase out begins at $242,000 and ends at $252,000. Too many numbers for this early in the morning. So, if you've had a significant increase, check where you stand before making a Roth contribution. Your tax advisor can walk you through your specific situation. Now, let's flip it. What do you do when income drops? Okay, first thing, don't panic. A drop in income does not mean your retirement strategy is broken. It means you adjust. The most important thing you can do when income drops is do not access your IRA funds early. I can't say this clearly enough. Distributions from IRAs before age 59 and a half are generally subject to ordinary income tax plus a 10% early withdrawal penalty. So if you're in a 22% federal tax bracket and you take a $20,000 early distribution, you could owe $6,400 in federal tax alone. And that's before state taxes or the 10% penalty. That's potentially $8,400 gone from $20,000 distribution. That's painful. Your self-directed IRA assets, real estate, precious metals, promissory notes, private placements, on and on, they stay right where they are. They continue to be held by your administrator. They don't disappear because your personal income dropped. Let the account do its job. Second point, lower income can actually improve your tax situation on traditional IRA contributions or pre-tax contributions. If you're covered by a retirement plan at work and your income drops below certain thresholds, your traditional IRA contributions may become fully deductible again. If you were making so much before you couldn't write them off, maybe now you can. So a lower income year isn't all bad news from a retirement perspective. Now, a lot of our viewers are self-employed. They run their own businesses or work in industries where income varies significantly from year to year. If you have irregular income, this section is for you. The good news first. Retirement accounts are actually designed to accommodate irregular income if you know which ones to use. For a standard IRA, the flexibility is in the deadline. You have until April 15th or tax day to make your previous year contribution. So if January is slow, but March is great, you can wait and see where you land before committing. For SEP IRAs, the contribution is calculated as a percentage of compensation. In a low year, you contribute less. In a high year, you contribute more. That formula scales with you. Now, here's something specific to self-directed IRAs and alternative assets that I think a lot of people find interesting. When your self-directed IRA holds certain alternative assets, those assets can generate activity inside the account independent of what's happening with your personal income. For example, if your self-directed IRA holds a promissory note, essentially a private loan where the borrower makes monthly principal and interest payments, those payments flow back into the IRA, not to you personally, into the IRA. Same with rental real estate held inside a self-directed IRA. The rents go to the IRA, the expenses are paid from the IRA because the IRA is the owner. This doesn't change your personal income situation, but it does mean the retirement account can continue building its asset base in years when your personal contributions are limited or maybe even zero. One strategy that is worth understanding as income changes is using multiple retirement accounts simultaneously. You can hold a traditional IRA and a Roth IRA at the same time, subject to the combined contribution limit. You can hold an IRA and a SEP IRA or a solo 401k at the same time. Each account type has different tax treatment, different rules, and different strengths. When income is high, Roth eligibility may be limited, but SEP IRAs and solo 401k contributions are maximally available. When income is lower, traditional IRA deductibility may be at its strongest. Understanding how these interact and building a strategy that uses the right combination for your current situation is exactly the kind of thing your tax advisor and financial advisor are there to help with. Mountain West IRA can administrator any of these account types as self-directed accounts. We hold the assets, process the transactions, maintain the records, but the strategy, that's between you and your qualified advisors. Quick but important reminder on compliance, because the rules don't change just because your income does. Contribution limits and earned income. If your income drops, your maximum contribution may drop with it. Excess contributions, which are contributions either above the annual limit or your earned income, carry a 6% annual excise tax until corrected. So that's important. All right, let's wrap this up. Your income will change over time. It changes for almost everyone over a working lifetime. The question is whether your retirement strategy changes with it or whether it just sits there operating on settings that no longer match your reality. When income goes up, consider exploring higher contribution limits, new account types, and expanded options. When income goes down, protect existing assets. Don't withdraw early. And check whether deductibility has improved. When income is irregular, use the deadline flexibility, use accounts designed for variable income, and let your self-directed IRA assets keep working inside the account. Mountain West IRA is here to administer your self-directed IRA, to hold your assets, process your transactions, and make sure the administrative side runs correctly. We're not advisors, but we are educators. To learn more, visit mountainwestira.com or call us at 888-377-3311. And you can always use the QR code in the corner to reach out and schedule a time to get your questions answered. Don't forget to comment if you have a question, and like, share, and subscribe to get notified when we load more educational content. Thanks for watching, and I'll see you next time. Bye.